Welcome to StockStream's Education Series. This presentation is brought to you by StockStream Financial Services in collaboration with MyStockStream.com. Today, we will look at the basics of risk management. We recommend that you treat the contents of this presentation strictly as educational and informational in nature. We propose that you learn concepts of analysis using StockStream Education's training material, then follow StockStream experts at MyStockStream.com to see the techniques you have learned being applied to live markets. Once you are comfortable with a particular technique, we recommend that you conduct your own analysis, get it reviewed by a StockStream expert, and then put it to trade in live markets. There are two types of risks to any position in your portfolio: company-specific and market-specific. The company-specific risk, as the name suggests, is related to things that can go wrong with a specific position in your portfolio. For example, if you are holding the stock of a company that runs into corporate governance issues, your portfolio suffers due to company-specific risks. This type of risk can be minimized by diversifying your portfolio or using stops on individual positions. Diversification involves distributing your cash into different stocks or asset classes. The second type of risk is market-specific. This risk is due to the broader market sentiment. For example, if the broader market sentiment is negative, even the best stocks can go down. This type of risk can be eliminated completely by hedging your portfolio. Hedging involves taking an equal but opposite position to your portfolio. For example, if you are long, you can hedge your portfolio by taking a short position in the index futures. We will look at hedging and diversification in more advanced courses. The most basic form of risk management involves having a trading strategy that gives you a price to enter a trade called the entry price, a price to exit the trade if it goes against you called the stop-loss level, and a price to book profits called the limit. Technical and fundamental analysis techniques are used to determine a trading strategy. Risk management in its basic form is an easy concept to use in theory. All that you need to do is to have a defined entry, stop, and limit for every trade that you take. In practice, however, very few traders are able to use this concept on a consistent basis. Lack of discipline and emotions involved in trading prevent use of proper risk management techniques. In fact, most traders who lose money do so not because of incorrect analysis, but because of poor money management. Some of the common mistakes made by non-profitable traders are: they cut their winning trades early. Now, this is a direct consequence of not having a defined limit, and the result is you make less money on profitable trades. They keep their losing trades. This is because they do not have a defined stop for their position, and the result is that you lose a lot of money on the few losers that you have. New traders are also focused on increasing the number of winning trades rather than the profitability of individual trades. This is not necessarily a bad thing, but by focusing entirely on the number of winners, most traders end up losing way more money on the few losers that they have than they make on all their profitable trades. All these mistakes can be overcome by having a consistent, defining trading strategy. This slide summarizes the trading strategies used by different types of traders. A beginner is more focused on analysis techniques, which gives him an entry strategy. This type of trader hardly ever uses a defined stop loss. Because he believes that all losing trades will eventually become profitable, the few trades he exits for a loss are either margin calls or panic exits. There are no defined limits on trades, also because he believes there is more money to be made on all profitable trades. So he ends up making nominal money on profitable trades and losing a lot of money on losing trades. Definitely not a good strategy to follow. Intermediate traders are more mature, but are still focused on analysis techniques. They, however, set a strict stop loss on their trades. They still do not use a limit, which leads to low profitability on winning trades. Again, not a good strategy to follow, but better than a beginner. A professional trader understands the concepts of a lasting strategy and uses proven risk management techniques and trading strategies to be consistently profitable in the long run. This slide is a summary of some of the basic ideas and rules of thumb applicable to risk management. First and foremost, you should treat trading as a business. As such, you should look to be profitable on a consistent basis in the long run, rather than trying to look for big hitters. You should look to limit losses on individual trades to ideally 2% of your trading capital, maximum 5%. You should also try to maintain at least a 1 to 2 risk-reward ratio on individual trades. You should design a strategy to fit the market conditions rather than forcing your strategy on the markets. For example, if the market sentiment is negative, you should not be looking at buying opportunities. You should have a defined trade plan before you enter a trade. A trade plan will give you an entry, stop, and limit for every position. The stops for every trade should be in price terms and time terms. So you should always have a time-bound stop. For example, if you are trading on analysis based on an hourly chart, your trade should not remain open for weeks. If the trade does not materialize in a couple of days, you should exit the trade. You should try to increase the profitability of individual trades rather than entirely focusing on the number of winning trades. This slide gives you a sample trade log for different types of traders. This slide should give you an idea on the importance of risk management techniques in determining profitability. A beginner trades a lot and is more focused on increasing the number of winning trades. As you can see, he is profitable on 90% of his trades. However, his profits per winner are significantly lower compared to his losses per loser. On the whole, a loss-making portfolio. An intermediate trader is more selective in choosing his trades. He also uses strict stop losses, and that is why the losses per loser have gone down significantly. However, because he does not use limits on his trades, the profitability per winner has not improved significantly. On the whole, he is still losing money, but not as bad as a beginner. Professional traders are very selective on choosing their trades. They only trade on their best analysis. Due to this reason, their percentage of winning trades is very high. Their profitability per winner is also high, and because they use stop losses, their losses per loser are low. On the whole, they are making a lot of money on their portfolio. So the place where you want to be is in the category of a professional trader. If you have any questions, visit mystockstream.com and contact us at StockStream Education. You can also contact any of our other experts covering Forex, commodity, or Indian equity markets. We will be more than happy to answer any of your investment-related queries. Thanks for listening to this presentation and have a great day.